Greetings, teacher. My name is Kalimul Gitat Rabu. I'm a BB 2017 student, and this is the first video of a total of 3 videos. And the reason why I separated the videos is so that it gets easier for me to upload the videos onto YouTube. So this is the first question, and this is the data that's given. And from the uh, the offshoots, we understand that this question is a variable costing, marginal costing, absorption costing problem. So what are variable costing and absorption costing? Variable costing, which is also known as marginal costing, uh, is a costing, an income statement making method or a costing method that uses manufacturing costs uh, that vary with output. So these are what? Variable costs. It uses these variable costs as product costs. The reason why we call them variable is because they vary based on the number of units produced. The outputs vary based on the number of units produced. So it uses these as product costs. Uh, these are usually direct material, direct labor, and the variable portion of manufacturing overhead. So these collectively make up the variable expenses or the product costs for variable costing. Fixed manufacturing overhead is not treated as a product cost under this method. It is actually treated as an expense or in the period cost, uh, not in the product cost. This is it. This is what variable costing is. And also selling and administrative expenses are also treated in the period cost. But absorption costing treats all manufacturing costs as product costs, regardless of whether they are fixed or variable. It absorbs everything. So the cost of a unit of product under absorption costing method includes direct material, direct labor like variable costing, variable portion of manufacturing overhead like variable costing, but it also includes the fixed manufacturing overhead uh, in it. So this makes it different from variable costing. So the reason why these two differ is in the way they take fixed manufacturing overhead uh, into consideration. One of them treats it as a period cost, and the other, with absorption costing, treats it as a manufacturing or production cost. Selling and administrative expenses in both cases are not treated as product costs. They are treated as period costs. So now, from the question, we understand that this company estimated the costs for period for the period with a planning of production for 600 units. So the data that's given is for 600 units. So it's not per unit, it's for 600 units. So the direct material is for 600 units, not $3,000 per 600 units, not $3,000 per unit. Uh, and yeah, and we also have a sales unit of 450 units. So we have to calculate, we have to make two calculations. One for 600 units, the production plan, and the other for 450 units, the sales unit. And the selling price is $86 per unit. This will come in handy when we do the calculation. And we're required to find these three, and we will start calculating now. So this is the data that we have. Sales equals uh, 600 units the for the production plan uh, times wait, yeah, times uh, $86 per unit. So we get 51,600. When we calculate the variable expenses, like how we defined variable costing, this by the way is the income statement for variable costing. We will add direct material, direct labor, and direct expenses, which collectively are called prime costs, with variable manufacturing overhead and variable selling costs. We will add these and we will reach the variable expenses. So direct material cost is 3,000. Direct labor is 12,000. Direct expense is 4,000. Let me check that. Yes. Variable and variable selling cost is 3,800. 800. Variable manufacturing overhead is 6,000. So now we can calculate the total variable cost, which is 3,000 plus 12,000 plus 4,000 plus 6,000 plus 2,800, which gives us 28,800 dollars. The contribution margin is we get the contribution margin by deducting 28,800 from the total sales, which gives us 22,800. The fixed costs are the fixed selling costs and the fixed production overhead costs. The fixed selling costs are fixed selling costs are 2,800, and the fixed production or production overhead cost is 5,000. So the total fixed cost will be 7,800. So to get the profit, all we have to do is deduct 7,800 from the contribution margin, and we will get 15,000. Now, for the absorption costing, sales is the same. Now we have cost of goods sold for absorption costing. Here we add direct material, direct labor, direct expenses, variable manufacturing overhead, and fixed manufacturing overhead. Mind you, when we added fixed manufacturing overhead and the marginal costing, we added it here. But here we're going to add it up here as a cost of goods sold. So the direct material is 3,000, direct labor is 12,000, direct expenses 4,000, variable manufacturing overhead is 6,000. The fixed manufacturing overhead is 5,000. So add all these. Sorry. We get 30,000. This is the total cost of goods sold for absorption costing. Now the gross margin will be deducting 30,000 from the total sales, which will give us 21,600. Now the selling expenses are the addition. We get the selling expense by adding fixed selling to variable selling. Now the fixed selling expenses are 2,800. Variable selling are 3,800, and the total selling expenses are this plus this, which gives us 6,600. To get the net operating income or the profit, we deduct 6,600 from the gross margin, and we get 15,000. So in both cases, the profit is $15,000. Now we're going to calculate the same thing for 450 units. The profit for 450 units, but the data that is given is for 600 units and not for 450 units. So we have to find the unit cost of every relevant cost in our that is affecting the units, and we're going to multiply it by 450. So for example, direct material here is the given direct material is $3,000 per 600 units. So we have to find what the unit direct material is. So we calculate this by doing this. Direct material is 3,000 divided by 600. This will give us the direct material cost per unit. Direct labor is what, 12,000. 12,000 divided by, again, 600 gives us $20 per unit. And we have direct expense per unit, which is 4,000. We divide this by 600, we get $6.667 per unit. The variable manufacturing overhead per unit. So variable manufacturing overhead is 6,000 divided by 600 gives us $10 per unit, and we have the variable then we have the variable selling unit selling cost per unit equals variable selling divided by, again, 600. Now we have got the unit cost for this that we will use to calculate for 450 units. So let's go and try and calculate the variable costing for 450 units. Again, sales is 450 units times $86, which gives us 38,700. Then we're going to calculate the variable expenses. Direct material cost, the unit direct material cost is 5. We're going to multiply this by 450 units, and we'll get 2,250. The same will be done to this. $20 per direct, $20 of direct labor per unit times 450 units gives us 9,000 equals direct expense per unit is this, multiply it by 450, get 3,000. Variable manufacturing overhead is 10. 10 multiplied by 450, we get 4,500. Variable selling cost per unit is this, multiplied by 450, we get this. Now the total variable cost is, again, the addition of these. So we get 21,600 as a total variable cost for this. Then the contribution margin is sales minus total variable cost, which gives us 17,100. Fixed cost calculation is, now pay attention that we did not multiply the fixed costs to get the per unit value, because fixed costs are fixed whether we produce 400 units, 1 unit, a million units. fixed costs are going to be fixed. So fixed selling cost in this case, in our case, is 2,800. The fixed product cost is going to be, the fixed manufacturing overhead cost is going to be $5,000. So let's fix this. Fixed product production overhead cost. The total cost would be this plus this, which gives us 7,800, and we're going to deduct 7,800 from the contribution margin, which gives us $9,300 as a profit. Sales again is 30,700. Cost of goods sold, basically we've calculated the direct material and stuff like that, all the necessary data from here, so we're just going to copy everything and bring it here. So the direct material is 2250. Direct material, direct labor is 9000. Direct expense is 3000. Variable manufacturing overhead is 4,500. Fixed manufacturing overhead or fixed production overhead cost is 5,000. And we're going to add this together, plus this, plus and we get this amount. This is the total goods sold, and the gross margin is sales minus this, selling expense is fixed selling plus variable selling. Fixed selling is 2,800. Variable selling is 2,850. The total selling will be plus this, and we're going to deduct 5,650 from the gross margin. So we're gonna, so in both cases, the profit calculation does not vary in both cases, and but when we compare the 450 units sold to the 600 units sold, the company will get more net operating income or more profit if it sells what it produced, what it planned to produce, or if it sells the 600 units, the company will make more profit. So this is the end of question number 1.